Well, greetings if you're joining us online. And what we will do today is to go back into chapter 26, and we're going to pick up on the time value of money. So as you get prepared to listen to this session, I'd like for you to have a couple of documents in front of you. So as I share my screen and show you, the first will be the outline for chapter 26. I'd like for you to scroll down to Roman numeral 4 about the time value of money. The other thing that I would like for you to have in front of you are some interest factor tables. So for present value and future value. And you can source these either under Canvas files. I have a PDF of 4 tables there, or you can look at them in your book, and these came from the previous edition of the book. They're toward the end. Or you can actually access interest factor tables online. There are plenty of sources for them. All righty. Well, as I come back live for a minute, let's think about this. This underlies time value of money. When would you rather have a dollar? Will it be now or in the future? Now, you betcha. Rather have it now. I could spend it. Okay. Or if I were really thrifty, and again here after Easter, as I've said, maybe think about Easter Tuesday when you have kids. That way, the Monday after Easter, you'll have plenty of time to save money because you can buy discounted Easter candy. And with the savings, if you'd like to be thrifty, you can invest that. So you can invest that at some rate of return, whatever that may be in percentage terms. We'll work with that today. By the way, interest, which a bank pays us, is rate of return, although they pay very little today. But we will work with that rate of return. As you see in the interest factor tables, across the top, there are some percentages which are rates of return. Again, just like interest rates. So we can invest that dollar that we've saved, or hopefully multiple dollars, and make them grow. So in the future, in our investment, we would have more dollars than we have today. That's the time value of money at work. And it's a good thing that we have the time value of money, especially in today's inflationary environment. Because in the future, it looks like we're going to need more what? Dollars. You bet. And if we don't make that investment grow fast enough, we're going to be left behind. We're going to have a big chunk of our spending power taken away from us, which unfortunately is happening to a lot of retirees right now because they're living off their investments. We'll discuss more about that later. With these interest factor tables, again, you can source them in multiple places. And I think you'll be fine working with these, especially in this class. Then when you get to managerial finance soon, you'll be working with these tables once again there. And they're going to have more complicated problems for you to solve. So they're going to kick things up a notch. Also, if you're an accounting major, as you move on to Financial Accounting 1, you're going to have increased complexity of problems in there too. So if you learn these interest factor tables really well here in this class, you'll do really well in those 2 succeeding classes. Plus, you may use these from time to time in your job or just in life. So we'll work with these. So let me go back to sharing my screen. And coming back to my handout, to the outline. So this time value money, well, bearing in mind that we are doing capital budgeting and we have two different capital budgeting methods left. And we've got to cover this time value money before we cover the remaining two capital budgeting methods because they're going to employ it. They're more sophisticated, but they give us better information. More sophisticated than the two we've seen before. And in B, again, the basic principle is the dollar we have today is worth more than a dollar we may have in the future. We'd rather have it today. Yeah, we can invest today's dollar and make it grow. Or if we can't bear to invest it, we can spend it today and, quite frankly, get more goods or services for that dollar today than we would get in the future. And the whole reason for that is inflation. So we're going to need to know three figures. We're going to need to know the principal, which we'll abbreviate with small p. Principal, you'll see how that's given to us. For example, if we're investing $100 today, we're going to make it grow. Well, that's the principal. That'll be pretty obvious. It'll be the amount we're working with. We'll need to know the number of periods, a small n. So if we're going to invest that in 5 years, we're going to see what we get out of this investment at the end of 5 years. There we have the number of periods and the interest rate, which will be given to us along with these others. And a small I is going to stand for that. Now, the number of periods may be stated in days or months or quarters, quarter being 3 months of the year. Well, if so, the interest rate needs to be adjusted to reflect the number of periods in the year because we're given annual interest rates in the present value tables and future value tables, the interest factor tables, that is. So, for example, let's say that we have an 8% annual interest rate, which is paid quarterly for 3 years. Well, that 8% is annual. So if that is paid quarterly, 4 times a year, in other words, well, we're going to multiply the number of periods by 4. So if we have, in this case, 3 years, we're just going to multiply that by 4. Because again, this 8%, it's spread over 4 periods during the year, 4 payments. And the interest rate, we're going to divide by 4. So that balances things out. That'll be 2%. Everybody see what I did there? Okay. We won't see that in this class. I wanted to throw that in at this juncture because in managerial finance, you will see that. And if you take Financial Accounting 1, you will see it there too. Now in D, interest may be simple or compound. Well, simple interest is calculated only on the principal. We don't add back any interest earned to earn interest on that. And simple interest is not very common. Compound interest assumes all interest is reinvested. So we throw it back in and we earn interest on the interest, and therefore calculates each interest amount based on the principal plus all other interest earned to date. And we actually assume compound interest in accounting. If you want to glance that figure later on, if that helps enlighten you, that's fine. If not, that's okay. I think it's pretty simple concept here. And we'll work with compound interest. In future classes, you'll work with it there too. Again, almost every venue in life is compound interest, not simple interest. So just like in a bank account, as you earn interest, that's thrown back in and you earn interest on the interest, albeit not very much these days again. Now, the principal may be stated as a lump sum amount or as an annuity. So if we're going to invest $100 today and we're going to make it grow for 5 years in a bank account, that's a lump sum. We'll deal with that first, and then we'll deal with an annuity. So an annuity is a stream of equal installments or equal payments made at equal time intervals under the same interest rate. So if we were going to invest in this bank account, $100 per year, we do it at the same time every year, well, that's an annuity. So a stream of equal payments. By the way, there are a lot of annuities in life, such as, well, your cell phone. There's an annuity. You're paying the same amount each month. A lot of bills we pay are actually annuities. I pay Apple 99 cents per month for 50 gigabytes of extra memory on the iCloud. Well, that's an annuity to Apple. It's a pretty cheap one, but still it's an annuity to them. Businesses love for us to have annuities that are going to be collected by them, because this is revenue they can depend on, and they know the timing of that cash inflow. So they really do love them. So think about that whenever you get an offer from a business, such as sign up for this offer. You get it free for the first month. What kind of offer could we have? What's been in your email to sign up for free? Any ideas? How about added insurance on your cell phone? We have an offer for you where we will reduce your deductible. And I got something like this a while back. We will reduce your deductible if you pay us like $2 more per month for cell phone insurance. Well, in that case, you're paying an annuity on top of an annuity. You get the first month for free. But of course, to sign up for that free month, what you have to do, if they don't already have your credit card number, you will have to give it to them. So then they will, as they usually say, conveniently charge your credit card per month after this first free month. So be careful what you fall for. Or I know another one, YouTube. I'm posting videos there. Often I will see this. Sign up for YouTube TV. You seen that one? Yeah. And the first month, of course, is free. Well, I don't pay YouTube anything, but they don't have my credit card number therefore, but they want it because they would love to charge me every month for YouTube TV. And no, I haven't signed up. But they're hoping that people will forget after the first month that this is being charged to their credit card. They really are. Another example of an annuity is cable TV. Now, a very expensive one, by the way. Oh, yeah, I cut the cord a few years back. And I don't regret. Yeah. Does anyone still have cable TV at home? No. No. And again, I keep getting offers from Spectrum. Sign up for whatever plan, and we guarantee for the first year, for the first 2 years, you'll only pay X amount per month. Of course, again, they're hoping we will forget that that's being charged to our credit card. And after 2 years, what's going to happen? They'll charge you more. They will be certain to charge us more. Oh, yes. Yeah. Is cable TV an industry which is growing or declining? Declining, you betcha. Yes, especially because, well, people today can turn to other sources of whatever they would like to watch. And, well, I don't know this for certain, but I can certainly guesstimate. Most most cable subscribers fall into which age category? Older people, yeah, I bet. So here in Florida, I guess it's still big business. But as the years go on, obviously the industry will continue to decline big time. Or I could always sign up for things like ESPN or HBO, etc. Or what's been offered to me recently, the Disney bundle. Of course, it's free at first, but we'll have to pay for it eventually. So all those companies would love to get an annuity out of us. So just be careful about the annuities you pay in life, because it's a good way to fritter money away. It truly is. That's what those companies are hoping for. Now, as we read on about annuities, an ordinary annuity involves an installment at the end of the period, but there's another type of annuity. An annuity due, it is called. Involves an installment at the beginning of the period. And this class will normally assume an ordinary annuity. In fact, we won't see annuity dues. I just wanted to bring that term up so that when you see it, and you will, in managerial finance or in upper division financial accounting, you'll know what it is. So the more little previews I can give you in this class, the better off you'll be. And trust me, students who go on and take those classes, yeah, they're really glad. They've told me that many times. So just try and work these things in. No, I won't test you on these extra things, but they're just for your own edification. After all, I want my students to do better in managerial finance and upper division financial accounting and cost accounting, the upper division version of this class. Yeah, not that I'm competitive, but now in F, we'll consider both the present value and future value of money. So present value, how much money is worth right now? Okay, so $100 we're going to invest, that's present value. We invested for 5 years. We earn interest over those 5 years. We add that interest onto it to get the future value. In other words, what's going to be in that bank account or that other investment at the end of 5 years. So any questions there so far? All right. Now, again, I don't think you'll find it very difficult to work with these present value tables, but it's just a skill that you need. Now, as we calculate some present values and future values using interest factors, you could do the same thing on a financial calculator, or you could log on to the internet and find a calculator there. You can find websites to compute these things. But I want you to know how to use interest factor tables, starting from scratch. And the reason is that way you'll know what's going on. If you simply plug numbers in to a financial calculator or to some website online, you won't really know what's going on. You're behind the scenes, shall we say. and you'll be much more prone to making errors. We don't want that. Also, if you go on and take the CPA exam, and that means you'll major in accounting if you do, well, on the CPA exam, they have interest factors, which they give you, and they expect you to be able to use them. There's no financial calculator there or anything else to help you. So they want to know that you know how to do things from scratch. Because if you're going to be a CPA, again, you need to know what's going on behind the scenes so that you don't make errors. Yes, you can use financial calculator in your job, but you've got to know what that financial calculator is doing. By the way, you could also use Excel to calculate the same things we're doing today. But, well, if you do, again, you need to know what's going on behind the scenes. And by the way, one of the most common errors that auditors find are errors in Excel formulas. People thought they knew what they were doing, but they didn't. And that can cause a lot of problems on a company's financial statements. Auditors don't look kindly upon that. So here in G, as we use these interest factor tables, we're going to have 4 time values of money to calculate. So we'll have present value and future value. We will have lump sum and annuities. So there will come the 4. So the first 2 I'm going to look at will deal with present values. Present value of a lump sum first and present value of an annuity first. Present value is also called discounted value because, again, which is less, future value or present value? It is present value. We know it's less if we go back up and we look at this little reminder here. Future value equals present value plus interest earned. So again, that is saying the present value is less than future value. So present value we could also call discounted value. And it often is in business. Whoops. So for this, we're going to look at table B1. And it's used for lump sum amounts. We will use it to determine the value today of a lump sum amount desired in the future. In other words, what amount must be invested today to grow to a desired amount at a known future date. So let me show you an example of this with numbers. So for each of these in G, I'm going to come down to H, where I have an example. And for each one, and just under there, I've got a solution. So here in H, in our examples, first of all, calculate each of the following. Assuming a compound annual interest rate of 6%, which is paid once per year. And in each example, the principal, P, is $1,000 in or number of periods is going to be 5. So 5 years. We'll always deal with years in this class. And interest rate, of course, we were just given is 6%. So here in number 1, how much must you invest now to grow to a lump sum of $1,000 5 years from now? So we've got our principal, 5%, again in number of years, 5, interest rate, 6%, small I, but we need to look up an interest factor, and we're going to multiply that by 1,000. So for the interest factor, I'm going to need to bear in mind not the principal at this point, but number of periods of 5 and interest rate of 6%. So for this, I'm going to go to the interest tables, and I'm going to go specifically to table B1, the very first one that you have. It's the present value interest factor of $1, of $1 per period at an interest rate of whatever that may be for n periods. So if we have a principal of 1, that's what this is based on. I will show you. Let me look up the factor first. Down this left-hand side, we see these rows correspond to the number of periods. We want 5. And everybody see that? I can enlarge it. Okay, how about that? Good. Make sure these lights are on projection. Much better. So number of periods 5, we come down the left-hand side to that row. Then we see across top, we've got interest rates. We want to come over to the 6% column. So when we do, we see 0.747. Here's what that's saying. If we want to have $1 in our bank account 5 years from now, an interest rate of 6%, good luck in getting that for a bank, but for the sake of argument, assume we do. Banks used to pay that much and more. But if we invested 6% in the bank account, 5 years from now, our 74.7 cents will grow to $1 5 years from now. Again, that 74.7 cents is the present value or discount value. It's less than the future value of $1. So if we want $1 in the future, we'll invest 74.7 cents. And coming back to my handout, if we want $1,000 in the future, which is exactly what we want here, a lump sum of $1,000 5 years from now, how much are we going to invest? Well, let me do the math first. I will diagram this for you. From table either A1 or B1, depending upon your edition of the book, the interest factor is 0.747. Now, if we multiply this by the principal, well, 1,000 of those dollars times what $1 would be, 0.747, equals $747. And that's the present value that we must invest today. So coming back up this diagram, what have we done? Well, here in year 1, we wanted to see how much we would have to pay into this bank account. The present value to grow to that $1,000, and we're finding it. Now, we don't pay anything else into it, just this lump sum at the get-go. What we receive out of the bank account, nothing until year 5. In year 5, we want to receive that $1,000 out of the bank account. So we go to the bank, we say, give us our $1,000 and close the bank account. Again, we could do that. If we invested $747 today, here in year 1. Does that make sense? Okay, good. So 747, not just an airplane. Sadly, due to the pandemic, there are very few of those left on passenger routes, and none here in the United States. How many of you have flown on a 747? No one? Okay. Huh. Yeah. Always a very unique airplane. Okay, so no questions there. All right. Now, let me come back up to G and look at number 2. I'm going to do the same thing now for an annuity. So the present value or discount value of an annuity of $1. And I'm saying that because these interest factors correspond to a principal of $1. Then we just multiply by the number of dollars in our principal, and we've got our answer. So we'll go to table B2 or A2, depending upon your edition of the book, and this will be used for annuities. I will show you how. We'll use it to determine the value today of a stream of equal future cash installments. So coming down to H, looking at number 2. How much must we invest now to pay an annual payment, or an annuity, in other words, of $1,000 at the end of each of the next 5 years? Okay, let me diagram what's going on here under the solutions. So here in number 2, well, here in year 1, at the end of the year, we're going to get the present value of this annuity. What this annuity is, at the end of each of the next 5 years, we're going to want to invest some amount right here as the present value so that it grows and yields us a payment of $1,000 at the end of each of the next 5 years. We do not pay anything further into it. So at the end of at the end of 5 years, we're going to exhaust this bank account. The value of it is going to be 0. So we'll withdraw everything over the next 5 years. So what are we going to do? Let's go to table number 2. So table number 2, as we look here, again, the number of periods is 5. Then going over the column, which says 6%, we get an interest factor of 4.212. Everybody see that? Alrighty. So let's bring that back over here. As you can guess by now, this interest factor, we're going to multiply it by the principal, number of dollars in the principal. So $1,000, bless you, times 4.212 equals $4,212. That's the present value we must invest today. So what that factor is saying, if we want an annuity of $1 payments at the end of each of the next 5 years, we will invest $4.21.2 today. Well, we've got more dollars than 1 in our principal. We have 1,000 of them. So we simply multiply by 1,000. So coming back up here to number 2, the present value as we find it is going to be $4,212. If we invest that today in a bank account or hopefully in something like a mutual fund, which pays more than a bank account, then the 6% is much more realistic. But we're going to receive out of this account at the end of each of the next 5 years, $1,000. We will exhaust this account at the end. Yeah, someplace where this definitely applies. If someone is thinking about the retirement fund, if their employer is paying so much money per month into that retirement fund, and that retirement fund, by the way, for-profit businesses is called a 401k. And for government and not-for-profits, most of them do 403Bs. 401k and 403B simply correspond to the subsection of the Internal Revenue Code under which these are allowed. So since I work for a not-for-profit, I have a 403B. So Florida Southern takes out, well, I should say Florida Southern pays into this 403B 10% of my salary. So that's quite good. And I pay actually a little bit more than 10% into it. I pay up the maximum allowed by law. Why I pay into it is pre-tax. In other words, it's not taxed right now. So it makes it even better. I'll pay tax when I finally retire and withdraw from it. But on the day I retire, I've got a fixed amount in that 403B. Yes, can still earn interest or some other return. But basically, I'm given a fixed principal, which is where a fixed income comes out of. So however much I will receive per month, that's the annuity that will be paid to me, just like this $1,000. Of course, I hope that the principal of that 403B, once I retire, is going to be enough to give me a really good annuity payment. We shall see. I have done well, so hopefully I'll be okay. Any questions there on the present value of an annuity? All right. Let's come on back to G. So G, number 3 and 4, we're ready for future values. So now we're going to be determining the value in the future. And we'll do it first for a lump sum and second for an annuity. So first of all, the future value of $1. We'll look at table 3, used for lump sum amounts. And we'll use it to determine the value in the future of a lump sum. All right. Let's see that under H. Number 3. So how much will you receive in 5 years? So that's in the future. If you invest a lump sum of $1,000 now. So $1,000 is our present value. We invest that now. In 5 years, that's a future value. It's a very safe bet that in 5 years, that value that we will have in our bank account or brokerage account, wherever we invest this, is that future value going to be more or less than 1,000? More. Hopefully a lot more, but well, not a whole lot more here. But if we were investing that in a brokerage account, which is investing in the stock market, maybe that's a mutual fund. Well, the stock market does really well in the next 5 years. We could have a whole lot more than 1,000. So let's just see that though under the confines we're given here in number 3. So let me diagram what's happening. 5 years. We pay into the account now, here in year one, $1,000. Again, we could say that's the present value. We don't pay anything else into the account. Interest will be earned, but we don't pay anything else into it directly ourselves. We don't receive anything out of the account until the end of 5 years. That will be the future value that we get out of this account, what it grows to. And again, that future value will be more than the present value of 1,000. We need table number 3. Let's turn table 3 and look up an interest factor. So again, period 5. Interest rate 6%. We look at the intersection here. That's 1.338. So this is saying if we invest $1 under these constraints today, it's going to grow to $1.33.8 in the future. If we invest 1,000 of those dollars, you can bet we're going to multiply that by 1,000. So sure enough, if I come back here to the outline, I look at the solution. Again, there's the interest factor, multiply this by P. Thus, 1,000 of those dollars times 1.338 equals $1,338. And that's future value that we're going to receive in 5 years. So that's how much that $1,000 is going to grow to. Again, that future value is more. Future value right there in that little diagram, 1338. Any questions on it? Okay, as I come back to G, we've got one more. Future value of an annuity of $1. So we'll use this for annuities. We'll use it to determine the value in the future of a stream of equal cash payments. So instead of paying just $1,000 into that bank account today, we're going to pay $1,000 at the end of each of the next 5 years. How much will that total up to at the end? Well, let me come down again to H, looking at the solution number 4. So we've got 5 years. We're going to pay into this account $1,000 at the end of each of the next 5 years. Let's see what we receive out of the account. Well, nothing for the first 4. Finally, at the end of 5 years, we're going to get future value. It will be all those principals plus interest. So principal, I should say, is 1,000, but we pay it in 5 times. We pay $5,000 in this account. So that future value, is it going to be more or less than $5,000? Going to be more because we'll have interest. All right, let's look at table A4 or B4. Is it B? So future value interest factor of an ordinary annuity of $1 per period. So again, that means we pay at the end of the year instead of an annuity due, which we pay at the beginning of the year. So period 5 again, interest rate 6% once again, and there's the factor, 5.637. Everybody see that? Okay, that's saying if we pay $1 at the end of each of these 5 years into this account, we'll get at the end a future value out of the account of $5.63.7. But if we've got 1,000 of those dollars, you can bet we're going to multiply by 1,000. So sure enough, here in number 4. From the table, the interest factor is 5.637. We'll multiply this by P, which is 1,000. Thus, 1,000 times 5.637 equals $5,637. That's a future value that we'll get in 5 years. So yes, indeed, that was more than the 5,000 we paid into it. It's just like as I pay into my 403B account and Florida Southern also pays into it. Well, an annuity is going into it. So there will be a future value of that annuity that is more than the sum of all those payments. So payments are going in right now, but again, once I retire, payments stop. In fact, payments start coming out to me. So, well, you can see the annuity on both sides of the coin there. Okay, any questions there on the time value money? And I realized that nobody had seen the time value money before. All right, so since we're actually ahead of the game, I'm going to go ahead and stop there for today and declare the rest of time today lab time. I'd like for you to go back and take a look at these and, excuse me, especially look at the present values, the first 2, although you should know all 4. We're going to be using that present value on Thursday as we go over the next 2 and final 2 methods, in fact, of capital budgeting. So we'll have the net present value method, and we're going to have, after that, the internal rate of return method. So that'll take care of this chapter. And then after that, I have just a little bit to say about accounting information systems. It is not even a whole chapter. So then we will have covered all the material for this class. So we're almost done. Feels good, doesn't it? All right. So for those of you online, take care. Good to see you, virtually at least. And for all of you here in class, thanks for coming. And I look forward to seeing you Thursday. Have a good one. Thanks. Bye-bye.